It's a story about a loophole, a gap in financial regulations so wide that a $36 billion fortune could be built almost entirely in the dark. And that loophole is still open today. To understand how this happened, we have to go back further than 2021, to a young fund manager trained under one of the most legendary investors on Wall Street, who was already, quietly, breaking the rules. Bill Huang is one of the so-called Tiger Cubs, protégés of legendary investor Julian Robertson, trained inside one of the most successful hedge funds in history. Robertson personally seeds Huang's own fund. On paper, this is the pedigree of a golden boy. In practice, it's about to go very wrong. By 2012, Huang's fund, Tiger Asia Management, pleads guilty to wire fraud, insider trading in Chinese bank stocks. He pays $44 million to settle the case and gets banned from trading in Hong Kong. On Wall Street, that should be a career-ending scandal. It isn't. 1 year later, Huang reopens shop under a new name, Archegos Capital Management. Same money, same strategy, new label. And that label is the whole trick, because Archegos isn't registered as a hedge fund. It's registered as a family office. A family office manages one family's own money, not outside investors, so under the law, it doesn't have to register with regulators or disclose its holdings. Some banks even blacklist Huang at first over his fraud record. They let him back in anyway, because his trading generates enormous fees. Then March 2020, COVID crashes the market. From his Manhattan apartment, Huang starts building enormous, concentrated bets on a small handful of stocks, media companies, Chinese tech names. He isn't buying the market, he's making a few massive, all-or-nothing wagers. In about a year, Archegos' equity explodes, from roughly $1.5 billion to $36 billion. Almost none of that growth is Huang's own cash. It's borrowed, and it's about to get borrowed on a scale nobody outside his inner circle understands. Here's the mechanism that makes all of this possible.